All right, thanks, Scott and Ryan. Yeah, we want to welcome everybody to our fourth quarter 2023 quarterly market update. And if you've been on a couple of these now, you know we do these every quarter, so we definitely invite you to continue to come back and view the quarterly, our quarterly presentation. And remember too, you can always go out to YouTube if you dial in late or if you have questions on something that we said. The replay is always available to you on YouTube, so you can go on there, watch it, like it, subscribe, all that good stuff. And then if you ever have questions, we can email it out or get in touch with you. But again, thanks for joining us. We're going to keep this to 30 minutes. We'll be done at 4:30. If we have time for questions, we'll answer those, but we try to keep this moving pretty quickly to make sure we get everything in within 30 minutes to respect your time. So with that, again, I'm Brian Reese, and I've got Scott Jones and Ryan Ironman on the call with me as well. And just a quick, for those of you that don't know us, a quick who are we and what is this all about? Ryan and Scott and I work with Tim Ironman and John Lippi. There's 5 advisors, and then we've got 3 support staff with Julianne, Tanya, and Davia. And we're at Crocker Park. You know, between the 5 advisors here, we've got over 100 years of experience, and we've got 12 designations that really goes to show what we specialize in, both on the retirement plan side and personal financial planning. So we're here for you guys, whether you're a client or not yet a client, in these sort of sessions to explain what's going on in the market. And hopefully, as you look at your retirement account statements, these kind of calls make sense and kind of pull it all together for you. But here's all of our contact information, our great profile pictures. Again, email us, reach out if you have any questions about this or anything else. And then on the next slide, I think if you're a 401k plan sponsor or a business owner, just know that as your 401k advisors, I think from a communication standpoint, it's important to recognize that not only are we doing quarterly plan reviews and investment reviews with the investment committee or the business owner or plan sponsor, but we also are able to do educational meetings. So if you're not a client of ours, ask yourself, are you getting quarterly review meetings with your advisor, no matter how big or small the 401k plan is? And are your employees getting the help that they need within the retirement plan? And then from a personal planning standpoint, as certified financial planners, most of what we do starts with a financial plan for clients, help them with a roadmap on where they're trying to get to. And I think from that standpoint, a lot of these things apply both from a quarterly newsletter, an email. Any clients would see an email come out every Friday from Ryan Ironman, and then ongoing commentary, help, assistance, great website. And then hopefully if you're a personal client, you've downloaded the Raymond James Client Access app as well. As far as what we're a couple disclosure slides here, but as far as what we're gonna talk about today, we've got both looking backwards and looking forward. So we're going to Ryan will talk about the 10 themes for 2024, talk a little bit about recession, which, as you might know, we've been talking about recession for a while now, and we're by most people's accounts, we're not there yet, but we may be headed towards a mild recession. So again, Ryan will talk more on that. Stock market outlook, bond market outlook by Scott Jones. And then Scott will wrap up also with the importance, kind of just as a reminder, the importance of diversification. So as far as what I'll be talking about, right? You can go to the next one. Oh, are they going to come out one at a time? There we go. Yeah, so Ryan, I'll hit these real quick and let you move on to the next one. But number one, the U.S. economy. You know, where we're at now, hot and cold. If you've been invested in the right investments, you probably did really well in 2023. I think it's still a reminder, though, as far as diversification goes, to make sure that you're properly diversified. Taking risk quizzes, if you haven't done that in a little while, to make sure you're positioned right for 2024. Number two, is with monetary policy. And I'm right halfway through. I'll flip it over to you because I know you wanted to talk about the last few of these.
Okay.
Monetary policy. I think that one of the big themes for 2024 is going to be what does the Fed do? I by most people's accounts, the Fed will start cutting rates this year. Stock market and the bond market, there will be reaction. If you turn on CNBC, the interest rate cuts, a lot of people are starting to talk about those are already baked into the stock market. But we do anticipate interest rate cuts next year. The market's expecting 5 or 6, but at Raymond James, we're thinking 3 to 4 interest rate cuts next year. Fixed income, again, Scott's going to talk a little bit more about this specifically towards the end, and he'll talk more about the relationship between interest rates and fixed income and bonds. And why is that, of course, important? We want to relate everything back to our clients. Why is that important for you based on your 401k accounts and your overall investment portfolios? Because with rate cuts, fixed income will move for us, should move for us in 2024. So making sure you're positioned for that properly. And then U.S. equities. Every year for, gosh, probably 10 years, and I'll hit a slide on this later too, but we always hear people talking about it's got to be the year for international. It's time for international to outperform the U.S. market. The reality of it is the international investments in general haven't outperformed the U.S. in at least 10 years. And we at Raymond James don't believe that that's going to happen this year either. So doesn't mean we don't diversify our clients to own some piece of international and emerging markets, but U.S. equities, we believe U.S. equities are still in a position to outperform versus the international counterparts. And Rye, with this one, I'll let you go from 5 to 10.
Okay. Thanks, Brian. So as far as what sectors we are looking at for keeping an eye on for 2024, there's 3 major ones, tech being number 1, with AI being adopted more and more. We think that that's going to be strong for the tech sector. Healthcare is another. It was down in 2023. We think it'll be up in 24. And then industrials and manufacturing, we think that with the CHIPS Act and the Inflation Reduction Act, that those are going to be beneficial for that sector. A lot of government spending and stimulus going into those sectors. Small cap stocks, a couple things to note there. They are trading at a record discount to large caps right now. Another couple interesting facts about small caps: they tend to outperform right after recessions. So if we're expecting a recession in the near future here, so might be some upside potential in the second half of 2024. Small caps also outperform after rate cuts. So the market's pricing in a couple of rate cuts throughout the year. So in the second half of the year, they could that could be a good sign for those. International equities, as Brian mentioned, we're still favoring U.S. equities. And then oil and energy. RJ is taking a contrarian call on oil. A lot of people are saying oil prices are going to come down in 24. Raymond James thinks that they're going to rise slightly with the ongoing geopolitical risk, and India and China, their economies are sort of rebounding right now. We think that oil prices are going to rise slightly. up to potentially $85 a barrel. Volatility. Our expectation is higher volatility in 24. In early 2023, pretty much everyone thought that 23 was going to be a rough year with a recession coming, high inflation, Ukraine war, things like that. And then everything kind of ended up being less bad than everyone thought. So in 24, it seems like the opposite thing is happening, where everyone's sort of expecting this great run in the markets to continue. So we're kind of taking another contrarian position there, and thinking with the election coming and unemployment numbers starting to tick up, that it might be a little bit more volatile. And then the last theme is just to focus on asset allocation. We always encourage everyone to keep a long-term outlook. We've seen throughout history that not trying to time the markets and focusing on, sound diversification is always the better approach than to try to time these market moves. Okay, so next slide here. These are a couple of the indicators that we're looking at that kind of indicate we might be seeing a recession sometime in the second quarter. Number one is slowing labor market. Unemployment, like I mentioned, is ticking up a little bit. Number two, hotel occupancy is at a 3-year low. Along with that, restaurant performance is slowing down. Luxury watches sales are slowing, which sort of indicates that people have less discretionary income to spend. And then similarly, architecture billing is slowing, which means really less construction, things like that. An interesting chart here on the right. This plots all of the recessions going back to, I believe, the Great Depression. So there's 13 out of the 13 recessions that we've seen, 3 of them have happened in the 4th year of a presidential term. So it's not uncommon to see recessions in an election year going up to the second term. This chart is our prediction on the severity of the Q2 recession that we're predicting. Again, this plots all the recessions going back to, I believe, the Great Depression, and showing that the average recession is about 2.5% GDP decline. And our prediction, as you can see here on the right, is would be very mild, possibly the most mild in history, at less than -1% GDP decline this year. And then a couple of reasons why we're predicting a mild recession in the second quarter. Real quick, the first one is we're not expecting any major economic shocks. The prior 3 recessions were really, the dot-com bubble, the housing collapse, and the pandemic. Those were all sort of major events that sort of influenced the recession following. We don't see anything like that on the horizon. Number 2 here, we expect job losses to be minimal. The unemployment numbers are continuing to be very low, and job openings are staying higher, outpacing the unemployment numbers. So we don't think companies would be quick to make any layoffs or anything like that. Government spending, the recent CHIPS Act and the Inflation Reduction Act should create some stimulus in certain sectors. And then we have all-time productivity highs in the labor market. And then also another thing we've been keeping an eye on is the household net worth is at an all-time high. So that should influence consumer spending in a positive direction and help out the GDP in the near future. Then the last slide I'll cover here quickly is our forecast for next year. On the left, you see what the market is anticipating as far as what's going to happen. And then our forecast is on the right. So the market's pricing in no recession, continued growth into 2024. The Raymond James forecast is a mild recession starting in second quarter. The Fed monetary policy, the market's expecting 6 rate cuts. Raymond James is expecting only 3 to 4. The equity markets targeting S&P reaching at least 5,000 by year end. And RJ is predicting about a 3% upside from the current levels. S&P 500 earnings, year-end estimate is 245 earnings per share. RJ is slightly lower at 225. And then I think I mentioned before, but we're also expecting oil prices to rise slightly by the end of the year. And with that, I will pass it off to Brian to talk about equities.
Yep. Thanks, Ryan. Yeah, and before I go through this slide, I want to give everyone a reminder. This is a look back reminder on what took place in 2023. So the Dow Jones Industrial Average for 2023 was up 16%. The S&P 500 was up 26%. And then the NASDAQ 100, the tech heavy index, was up 55%. So 2023, and then on the fixed income side, the U.S. aggregate bond index was up. I'm cheating and looking at another sheet here, but up a little over 5%, 5.5% actually. So 2023, really strong year across the board. So where we're at now, looking backward, this is a slide that we like because JP Morgan puts it together for us. It keeps things in context of where we're at, because it's easy to, in 2022, get wrapped up in how bad things were, and then in 23, how good things were. But from a historical standpoint, where do we fit? How does it all make sense? So this goes back to 1980, and it's a history of the S&P 500 index, and each gray bar represents 1 year in the S&P. On the left from 1980 all the way through the end of 2023. And real quick, in the black line across is the 0 point. So all the gray bars above that means the stock market finished positive. Gray bars below, market finished negative. But the stock market is, the US stock market, the S&P 500, is up about 75% of the time historically. And in this case, 33 of the last 44 years, the stock market was positive. What it also shows is the red dot. The red dot in each year is the low point in each year. So if we look back to 2023, all the way over to the right, S&P was up about 24%. I know I said 26, but about 24%. Remember though, it wasn't all up in 2023. In 2023, we were down at some point, down 10% on the S&P. And that's what that reflects here. Pick any year, and you're going to see whether it finished up or down, that there was a down point. You look back a couple of years ago, one of the outliers is that negative 34% down here. I think everybody probably remembers 2020 with the pandemic. We had a really quick drop off in the stock market, down 34% pretty quickly, but it bounced back up probably just as quick, if not more quickly, and we finished positive on the year. So again, I like it, shows good, keeps it in context, and the S&P is positive most of the time. And hopefully, whether you watch the business channels or not, hopefully you know that we are right around, we're at all-time highs. And the TV's on behind me. I don't know for sure, but I think we're closing today at all-time highs, both on the S&P 500 and on the Dow. The Dow crossed 38,000, I believe, for the first time ever. So I think Scott and I were kind of joking that one day we're going to get 40,000 t-shirts made for the Dow. Maybe it doesn't happen this year, but it will get to that point. If anybody's old enough, they remember when the Dow crossed post the Great Recession in 2008 into 2009, when the Dow was down as low as 7,000. I remember it crossing the 10,000 mark, getting back to 10,000, and now we're talking about 38,000. So, but again, this one is particularly referring to the S&P 500. Next slide is the kind of the 2024 market outlook. Raymond James economists talk to get opinions from a lot of different economists, and put together each year a bear, base, and bull case for the S&P. And remember too, it is subject to change. So as economic conditions change, outlooks can change. But as of the start of the year, the base case on the S&P 500 is 4850, and that's where you see a 60% probability. So if you were a betting person, you go with the highest probability, which as of today. And again, we closed right around 4850. So we might be a little bit higher, a little bit lower, but we closed right around 4850. So if we finish at 4850 exactly, then we're about even on the US stock market. Remember, this is the S&P. So being diversified means you have money internationally, some emerging markets, and then fixed income may be able to give you a little boost as well this year. The bull market probability at 25% is at 5,200. So that's pretty darn optimistic, I think. But that's the point of doing this kind of exercise, is to show what a best case scenario looks like. And then the bear market case, lower probability, 15% is what we put on that. But that's the S&P dropping roughly 500 points down to 4,300. So if at the end of the day you leave this call and you think that we might be flat on the US market to slightly positive, that's probably that's where we think we're going to be. Over on the right hand side, it's kind of a messy chart in my opinion, but the idea behind it is the impact of the Fed cutting rates. How does it impact the market? And the average, the royal blue average S&P 500 performance in all time periods following the first rate cut. So you can see that green vertical line is the first Fed funds rate cut. The all-time performance on the S&P, it's even to slightly negative, but then you see the climb back up. So maybe that's how we're positioned now, given the Fed rate cuts are coming, and we may trade in sort of a horizontal range, and with some upside potential. So I think that if we're around 4850, 4900 by the end of the year, maybe we get a little performance out of the emerging markets, and then fixed income can help the overall diversified portfolio. So I mentioned this, and Ryan did as well. This is U.S. equity performance versus developed market counterparts. And I've got a slide. Let's move this over here. There we go. Now I can see better. But all this shows is exactly what we said. The U.S. market has, I mean, this goes back to 2013, where all these markets were performing similarly. And then you can see back in 2000, if we go back to 2015, then you can really see the outperformance of the S&P 500 all the way. I mean, it just continues to get wider. Again, if you have been investing for a while, you think back to when there were better markets to invest in than the U.S. You think about the days of the BRIC portfolio, the Brazil, Russia, India, China, those emerging markets. At some point, things will perform better than the U.S., but again, we're not expecting that to happen this year. Generally, there might be some markets, specific markets that do, but generally speaking, the U.S. has outperformed for a while, and we do expect that to continue. And then, sorry, not Ryan, Scott, we're gonna turn it over to you for a little fixed income insight.
Great, thanks, Brian. Yeah, we just wanted to provide a quick update on bond market, how it might be impacting your investments. So last year returned 6% in the Barclays Aggregate Bond Index, a little bit of a return to normalcy. I will tell you a lot of that came in the fourth quarter, though, because the aggregate, we were down in the index for most part of 2023. And all of that really going back to what Brian and Ryan are referring to is interest rates. We saw a big run up in interest rates to kind of quell inflation. And that led to things like mortgage rates going up and trying to just kind of slow things down. And so that there's an inverse relationship. When interest rates go up, bond prices go down. But really, we don't have a chart for this on this call, but interest rates have been going down for a long time. If you ever had anybody that purchased a home in the 80s, they always talk about how their mortgage rate was double digits, and it's been steadily going down and was really lowered to zero after the financial crisis of 2008, 2009. So we've come off of zero all the way up to close to 5%, and that's where you see that big drop off in 2022, which caught a lot of people by surprise. So but we think with the Fed rate cuts potentially coming, this could be an opportunity to look at some fixed income again, because you can see 43 out of 48 years, this has provided a positive gain. It's been fairly steady most of the time. So Ryan, if you want to go forward, you can click through a couple times here. Yeah, let's stop there. So again, just reiterating, the Raymond James forecast is for the Fed to cut 3 to 4 times starting mid-year. The marketplace thinks it's going to be closer to 6 times. And what that means is every time that rate would be going down, there would be a price increase to underlying bond holdings in addition to yield. So again, it could be an opportunity to think about getting back into fixed income and appropriate diversification based on your goals. Ryan, if you want to go to the next slide. So again, this just shows you 2000 during COVID, what the different types of bonds were yielding. And you had, let's look at the US aggregate in the middle. The blue was 1% during the COVID low, which, it's hardly anything, not going to get anybody overly excited. But fast forward to the end of last year, and now we're up over 4.5%. And that's the kind of the interest, the yield that you would receive by investing in that type of bond, all the way up to high yield on the far right, which is up to 7.8%. So these are offering much more attractive yields than they were just a few years ago, for sure. Then Ryan, if you want to just finish up again, there was a lot of talk about 60-40 portfolio being not working, and that's just basically 60% in stocks and 40% in bonds. But you saw on that bond chart that the last couple of years have been negative for bonds. And so that means 40% of our portfolio really wasn't working. And there's a lot of people that said, well, it's just not going to work anymore. So I think that's going to turn the corner. You're going to see much better performance there. In 2023, the white box on the far right, asset allocation returned 14%. That's kind of a diversified, balanced portfolio. And over on the far left, the average annual return of a balanced portfolio is about 8.1%. So, you know, it's lower than what you see in the large cap in the top left, 14%. But with our forecast, you know, that Brian went through, you know, I think it's probably a good time to be considering diversifying appropriately, specifically if you're, you know, nearing retirement or you're considering making some withdrawals to meet different financial goals. You know, you want to make sure that your investments are diversified properly. So just to kind of wrap up, this is our quilt chart. We show it. It kind of just breaks down each asset class and different investments that you can choose from the highs and the lows. So Brian hit on the large cap US green box at the top. It's, you know, it's outperformed the international developed markets by almost double over the last 15 years. And so, you know, that continues to be, we continue to favor US equities. But you really want to, the goal here is to take out the highs and lows. And that's what that white box with the line in the middle is kind of representing. It's a much smoother way to invest over a long-term time frame. So,
Yes.
all right, with that, we can just kind of wrap up with some contacts. You feel free to reach out to us if you have any questions. Brian, Ryan, or I are always happy to help you in any way we can. And again, this webinar will be available for replay if you want to pass it along to any of the employees, participants in your company that weren't able to attend. Feel free to do that. And then I think the last slide, Ryan, is just kind of our, you know, if you would follow us on LinkedIn, QR code goes directly to our LinkedIn webpage for the company and the team. And appreciate your time today. I think we're a couple minutes over, so we're going to wrap up, and we'll see you next quarter.